Welcome back to Investing Talk Podcast.
Today we're looking at TeraWulf.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. This is a really interesting one because the whole story around this company is fundamentally changing.
Right. It's not just another digital asset miner anymore.
Not at all.
Yeah.
We're sort of moving past that early stage, and we're looking at what the market calls a structural re-rating. They're positioning themselves right in the middle of the AI infrastructure world.
And our goal today is really to figure out if that big transition justifies the incredible volatility and the pretty aggressive valuation we're seeing.
Exactly.
Okay, so let's unpack that pivot immediately. For anyone who's been following the space, TeraWulf, they started out mainly as a Bitcoin miner, super cyclical business. What is the fundamental change that's happening right now?
The change is actually pretty simple in concept. They're taking their physical assets, their power capacity, their data centers, and they're repositioning them.
Away from crypto?
Away from being just crypto infrastructure, yeah.
Mm-hmm.
They're moving toward becoming a high-performance compute or HPC platform. So, they're swapping out that very volatile commodity pricing, which is tied to Bitcoin, for long-duration contracted AI demand.
That is the key distinction, isn't it? They're trying to take an asset that was priced like a commodity and get it priced like, what, a utility or an infrastructure landlord.
That's a perfect way to put it.
Yeah.
And you can see in the numbers that it's already starting to work.
The growth is pretty remarkable.
It is. I mean, you look at their recent Q3 2025 results. Revenue was around $50.6 million. That's an 87% jump year over year.
Wow.
And what's crucial to understand is that growth isn't just random. It's directly tied to the early stages of this repositioning toward those high-margin HPC workloads. They're proving the thesis works.
And the market is clearly betting on that trajectory to what? To keep going? Or even to accelerate? The forward expectations are, frankly, astounding.
They really are. The consensus projections are calling for 2026 revenue to just soar to over $431 million.
So if they hit that, we're talking about more than 100% year-over-year growth.
That's right. And that forecast really signals that analysts believe this AI segment won't just grow, it'll grow explosively.
Okay, but hypergrowth always comes with a huge question mark. What's the moat? I mean, in a market that's flooded with companies saying AI, 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 what actually secures this revenue stream for TeraWulf?
That's where their background in digital mining actually became, funny enough, a huge competitive advantage.
How so?
Because the company is vertically integrated. They weren't just renting space in a warehouse somewhere. They own and operate their data centers, and this is the critical part. They secured the power contracts.
And we're not talking about just any standard high-cost power either.
Exactly. We are talking low-cost, low-carbon, renewable power contracts. This is a total game changer. Think about it. As the hyperscalers, the Googles, the Amazons, ramp up their AI data centers, energy use becomes this massive cost and, a huge environmental issue.
Right, so having that cheap, clean power already locked in is a huge draw for those big clients.
It's a strategic necessity for them. Yeah. And that structural advantage has to be what's driving their impressive margins, even while they're spending a ton of money to build out.
Right, the margins are surprisingly strong.
They are. They hit gross margins of 50.2% in Q3. When you can maintain margins that high while pivoting into such a capital-intensive space, it tells you your foundational cost structure, basically your power cost, is really, really good.
Okay, let's talk about visibility. Hypergrowth is great, but contracted revenue makes it predictable. It makes it bankable. How much of this future revenue is actually locked down?
A very substantial amount, actually.
Yeah.
Management has secured over 510 megawatts of what's called contracted critical IT load.
And that's basically the earning capacity of their data centers.
You can think of it as the earnings engine, yeah. Securing that with credit-worthy partners is the entire foundation of the bull case. It massively reduces your exposure to market swings. It's a long-term leasing model, not a spot market business.
But to build out 510 megawatts, you need an absolutely massive amount of capital. And we've seen them raising a lot of money, over $5 billion in recent months. That kind of money doesn't just show up unless institutions really believe in the underlying assets.
That's right. And how they raise that capital is the critical distinction. A lot of it is structured debt, like the $3.2 billion in senior secured notes. This funding is specifically tied to the projects themselves.
Not just a general corporate balance sheet.
Exactly. Which brings us to the core of the whole thing. the Abernathy joint venture.
Right. Tell us about that.
So the Abernathy project, it's a major 168-megawatt liquid-cooled AI data center in Texas. And this partnership is backed by long-term credit enhancement from the FluidStack platform and, crucially, a global hyperscaler.
And reports widely suggest that partner is backed by Google.
That's the reporting. And the numbers tied to this deal are almost hard to believe. They suggest this single project could generate $9.5 billion in contracted revenue over 25 years.
$9.5 billion. That figure, that really defines the whole story. It transforms them from a speculative growth play into, like you said, a pure play infrastructure asset with predictable cash flows.
But there's always a but.
Of course. So what happens if AI demand slows or they hit construction delays? Is that $9.5 billion a true lock, or does it depend on them delivering perfectly on time?
That's the sticking point. It's a major risk. The contract provides security, but performance still hinges on execution. If construction slips or costs run over, it can erode the margins or delay when that revenue actually turns into cash. The market is definitely pricing in near-perfect delivery right now.
That makes sense. Okay, we've laid out an incredible bullish case, low-cost power, massive contracts, but now we have to shift gears and talk about the balance sheet because despite all this growth, the company reports what looks like a disastrous GAAP net loss.
This is the essential complexity of this whole investment thesis. Q3 2025, they reported a GAAP net loss of about $455 million.
Which resulted in a negative net profit margin of over 330%. I mean, when you see a number like that next to 87% revenue growth, you have to ask what is going on.
You do. And it's not because, they lost a truck full of money or their power costs suddenly went crazy. It's an accounting issue tied to how they're financing all this growth.
So can you give us an analogy? Is it like they're paying for a massive factory up front and accounting rules make that whole cost show up immediately, even though the factory will make money for 20 years?
That's a perfect way to frame it. The huge loss is overwhelmingly from non-cash charges. Specifically, stuff related to the warrants and derivative liabilities they use to raise all that capital.
So they're not real cash losses?
They're non-cash accounting adjustments that depress the reported net income, but they don't reflect the underlying profitability of actually running the data centers.
Okay, so we need to look past the headline accounting to see the operational health. What does that look like when you strip out the noise?
The operational performance is actually inflecting very strongly. Adjusted EBITDA for Q3 is expected to be between 15 and 19 million.
And that's way up from the prior year.
Significantly up.
Yeah.
So that number tells you the core business hosting and operating the infrastructure is scaling its profitability quite well. They're making money on an operational level, but the GAAP results are just temporarily weighed down by all the spending on the future.
Right. So that brings us straight to the debt. The balance sheet is highly leveraged. Debt to equity is around 4.5 times. Free cash flow is deeply negative. That leverage is a massive immediate risk if the build-out slows down.
It's absolutely a major risk, no question. The company is financing this hyper-growth with debt, not cash it's generating itself yet.
But there's a nuance to that debt.
There is, and it's critical. The type of debt matters as much as the amount.
And that's the project-level financing we talked about earlier.
Precisely. Much of the recent leverage is structured as project-level financing. So that debt is ring-fenced. It's like a mortgage on a specific house where you already have a renter locked in for 25 years. The debt is secured by the contracted cash flows from those big AI customers.
So the debt is structurally safer because it's tied to an asset with a guaranteed revenue stream. It reduces the default risk compared to just looking at that scary 4.5 leverage number in isolation.
That is the investment thesis in a nutshell. The high leverage is a necessary evil for the build-out, but the quality of the contracts is meant to mitigate the risk.
Okay, let's pivot to near-term catalysts. What's going to move this stock in the next few months? It's a super volatile name.
The first thing to watch is some corporate housekeeping on December 9th. They have a mandatory conversion of all their Series A preferred stock into common stock.
So just cleaning up the capital structure.
Basically, yeah. Big institutional investors and index funds, they really prefer clean equity structures. So this is often seen as a positive step.
And then after that, it's all about the earnings report.
All about it. The Q4 2025 report, which
Yeah.
we'll see late January or early February 2026, that report is absolutely critical.
What will the market be looking for?
Confirmation. Confirmation that the new AI revenue streams are ramping up efficiently. They want to see cost efficiencies, and most importantly, any updated guidance on the 2026 build-out plan. Any good news on the commissioning of their next big data center, CB2, could really move the stock.
And what about institutional momentum? The stock's already up over 200% in 6 months.
So you need to watch the December ETF rebalancing and the February 13F institutional disclosures. If this company gets included or its weighting is increased in some of those big AI-linked ETFs, that could drive a lot of forced buying.
You mentioned volatility. We have to talk about the beta. The data shows a beta of 4.31. For anyone listening who doesn't track that daily, what does that actually mean for their portfolio?
It means extreme volatility. A stock with a beta of 1 moves with the market. A beta of 4.31 means this stock historically moves over 4 times as much as the general market.
So if the S&P is up 1%, this could be up 4 or 5%. But if the market's down 1%,
It could easily be down 4 or 5%.
Yeah.
This is not for the faint of heart. It is high risk, high reward.
and given that volatility, what's the analyst consensus? Most seem to have it at a strong buy, with price targets up to $24 and a median around 20. That suggests a pretty significant upside, maybe 52% from where it's trading now.
And that high target confirms that the analysts are looking way past the current gap losses, and they're valuing that massive contracted cash flow stream, but they're assuming perfect execution.
Okay, let's put it all together. The elevator pitch for the bull case, what is it?
The bull case is this is a high-growth AI infrastructure play with a defensible, low-cost renewable power mode. It's backed by blue-chip, long-duration contracts. If they execute the build-out, they will become a pure-play AI landlord, and you could see multi-year outsized returns.
And the bear case, where does it all fall apart?
It all comes down to financial fragility and execution risk. The high leverage means they have almost no margin for error. If the AI spending cycle slows down, or if they fail to turn those contracts into positive cash flow by late 2026, 2027, that debt burden could force them to issue a ton more stock or lead to a really painful refinancing.
So the investment decision here really does hinge on whether you believe management can navigate this really capital-intensive build-out phase and get to positive cash flow.
That's the key question you have to ask yourself. It's a transition that could lead to a massive reward or a pretty substantial disappointment. There's not much room in the middle.
We'll be watching those Q4 earnings very closely. Thanks for tuning in to Investing Talk Podcast. Remember to subscribe, like, and comment to stay informed.